Okay, folks, in this video we're going to be discussing income statements and budgets, and this one's going to talk about how we create an income statement. So the first thing off is there's really three different financial reports that you could come across. First one is a balance sheet, and that reports the company's assets, liabilities, and equity. So it's really like a big picture of what the company is worth. What is the business worth minus the liabilities and plus the equity, and sort of an overall picture of what the asset is worth. Okay. The next one is a statement of cash flows. Well, and that really describes the movement of cash through a business, right? So sort of a broader perspective of where money is going and how much they have on hand at any one point. It includes customer sales and purveyor payments, but also from investment activities, right? Like if you have other investments. The more common one that you're going to come across, and the one we're going to talk about, is the income statement. And it's the overall business's revenue, expenses, and profit. And that's what we're going to talk about as we go through this. It's really the big tool that we use as managers or chefs to make sure that we are in a profitable position. After we've paid all our bills, it's our roadmap of how much money did we make, how much money did we spend, and how much profit do we have, how much is left over. So income statement format can be written to cover any period of time. Generally, we look at the monthly. Most everywhere I've been in the industry, we do a monthly review of our income statement, or sometimes called a P&L or profit loss statement. So in the next video, we're going to talk about how we analyze those, and one of them is common size, and common size income statements include dollars and percentage for each line and category. So it's comparing, when we start comparing our budgeted income statement to what we actually did, we're going to start looking at common size. And the percentages express each line item as a percentage of sales, except for the subheadings under cost of sales, which I'm going to get to in a minute to clarify that point. So here's an example. You've got your total sales of $375,500, or $375,400. That's all the money you brought in from whatever you did in your restaurant. You sell T-shirts, sell food, sell drinks, rent rooms for meetings. Who knows, right? But that's all of your money. When we look at our labor, so our total labor cost would have been our departmental labor cost. I would assume this is for a month period. That $110,380, well, that's 29.4% of our total sales. That's where that percentage comes from. So what's an income statement look like? We always start with sales at the top of the sheet, right? So we always start with our revenue, which in most restaurants is going to be food and beverage, right? Those are going to start at the top of the sheet. And then once we've got those calculated, we're going to start taking out our major expenses first, and then to our minor expenses as we flow down the sheet. And then we get to the final bottom line of the sheet, which is a profit, right? And you probably heard that term, what's the bottom line? Well, are we making money or are we not making money, right? The percentages for food and beverage sales show the sales mix between food and beverage. And again, I'm going to clarify that when we get to the section and just be a little bit more detailed on that, right? Total sales is always 100%, right? Our total sales is that whole encompassing pie that we started with, right? Subcategories under cost of sales use different percentages, not based on total sales. For instance, food cost. Food cost, we want to know what our food cost was compared to the food we sold. I don't care what our cost of food is compared to the room rental or to the beverage sales, right? I want to know how much food did I buy compared to the revenue that I got from my food. That's my food sales. That's how we calculate food cost. We can very definitely identify what the food we bought and the food we sold, so we can compare those two to get a percentage. The next one that is calculated the same way is beverage cost. We're going to calculate the cost of our beverages as opposed to our beverage sales. Okay, compare those two so we know out of all the beverage sales we sold, 29% of our sales the cost of it was the beverages, right? Okay, so then our total cost of goods is going to be our food cost and our beverage cost, which becomes our cost of goods, and then we could compare that to our total sales, right? Gross profit is there, as we go through the income statement, there's going to be little lines that I call check-ins, and gross profit is one of those. Gross profit is what money we have left after our total cost of goods is deducted. So before we've taken out our labor cost or our rent or our repairs and maintenance or any of that stuff, our gross profit is how much of our total sales is left after we paid for our food cost and our beverage cost. So here's an example of a profit loss statement, and we're going to start working through this. So right off the bat here, the top of the sheet lists our sales, right? So we have two areas that we have sales coming from: food sales and beverage sales. So total sales is $982,755, right? These percentages are out of this total, right? So 727,194 divided by 982,755 gives me that 74%. My 26% comes from $255,561 divided by 982,755. These two added together will equal 100%, because if we're looking at where our sales are coming from, our total sales, we've got about this much is coming from beverage and this much is coming from food, right? For a total of $982,755. Okay, that's sales. Once we're done with that quick couple of lines, then we move into costs. We start taking out our largest costs first. So in this case, we have food cost first, right? So food cost is our single biggest expense in our restaurant, probably next to labor. That's probably pretty close as well. But here we have, from our cost of sales, we have $225,180. To get this 31%, we're going to divide this by the food sales, not by total sales, right? Beverage cost, we're going to take that $58,008 and divide that by our beverage sales to get this 23%. Notice if I add these two percentages up, they don't come up to my total cost of goods sold, because my total cost of goods sold is these two items added together to get my $283,984, but now that is compared to my total sales to get my 28.9%, right? Unlike above, where our sales added up to our 100%, these will not add up to our total cost, because really, if we go back to our pie, we've got our food and beverage costs that's coming out at around that. These are coming out of inside of that, right? I guess I got too many lines there, right? But one of these sides is beverage, and one of these sides is food, right? So they can't add up to 100%, and they can't add up to just adding them together, because you're taking a percentage of a different total, okay? Now, gross profit, what we've got left here, this $698,771 is $982,000 minus our $283,984, right? This is our total sales minus our total cost of goods gives us this first check-in point of gross profit. And again, we're going to take this calculation, $698,771 divided by 982,755, to find out what percentage of this pie that's left, 71.1%, is our gross profit, right? Now, if we were to take our total cost of goods and add our gross profit together, then we get our 100% for the whole pie. Okay? So really the biggest thing to remember in here is these percentages here are calculated on their respective sales. Can't tell you how many times I see this mistake happen where people calculate their food cost based on their total sales. Notice the blue. Food cost is calculated on food sales. The red, beverage cost, is calculated on beverage sales. And the green, total cost of goods, is calculated on, percentage is calculated on total sales. Okay? All right. So So our labor is the next section that we're going to deal with. And remember when I talked about labor, labor was both fixed and variable. But once we added them together, you had your fixed labor plus your variable labor, that made your whole total variable because there's that variable section in there that's going to move your labor up and down, right? So our labor is a cost of employees, both earnings and benefits, and generally on our profit loss or our income statement, we're going to separate out our benefits as a separate line so we know what percentage of our overall cost was for benefits, right? Our salaries and wages are going to include our workers' income, and then our cost of benefits, and then we're going to get a total and have another check-in of a prime cost calculation. Our prime cost is going to be our cost of goods plus our total labor, and our total labor is going to include both our salaries and wages and our employee benefits. So we can look at the next section of the profit loss statement here. So we've got our salaries and wages, we're $275,442, and that 28% is because we calculated that, let's make my blue here, let's go with green because we're going to go off the green color. Come on, green pen. So our salaries and wages, this was calculated on our total sales, right? To get that 28%. So 275,442 divided by 982,755 gives me 28%. My employee benefits, $52,155 to get this 5.3%. Guess what? This is divided by our total sales again. Our total labor costs, which is these two added up to get our total labor costs, our salaries and wages plus our employee benefits, gives me $327,597 divided by total sales. Gives me my 33.3%. Now, prime cost. Prime cost is now my total cost of goods, which I'm going to use blue for this now. Total cost of goods here, my $283,000 plus my total labor cost here. These two added up together will give me my $611,581. Prime cost is now this divided by, again, total sales. See a pattern developing? Every single percentage on an income statement sheet is going to be calculated by that number based on total sales, with the exception of our food cost and beverage cost. Okay. Okay, the next section of our income statement, we're going to have controllable expenses, which are usually all other semi-variable costs. So that could be, what could that be? Paper plates, things like that, right? We're going to have direct operating costs, which could be flowers, china, menu, uniforms, cleaning supplies, etc., right? And then we're going to have music and entertainment, whether that's live music or a subscription service that you subscribe to. We're going to have marketing costs. We're going to have utilities costs, so gas, water, electricity, general and administrative costs, so cost for accounting, telephone, internet, insurance, repairs and maintenance, so cost to repair our equipment and things like that, right? And then we're going to have another check-in of total controllable expenses. All these expenses that I just listed off, direct operating costs, music and entertainment, marketing, etc., those are all controllable. We can do something about them. We can, if it's utilities, we can turn the light on or turn the light off, right? They are variable expenses, right? Now we've got another check-in, income before fixed costs. So this is what money do we have left after we've spent on food cost, labor cost, our cost of goods, our labor cost, and all of our controllable expenses. How much of our total sales is left? Okay. So here we are. We're now calculating our direct operating expenses. So our direct operating expense $48,506 to get 4.9%. Where's that 4.9% coming from? This number divided by our total sales of 982,755, right? So all these lines going up to total sales. Every one of these are calculated the same way based on total sales, okay? Now, total controllable expenses here, this one here is a total of all of these guys, right? All these added up equal our total controllable expenses, 16.3%. Income before fixed costs, this is now our total sales minus, let's go up to the top here. So it's our total sales, our 982,000 minus our total cost of goods, minus our total labor cost, minus our repairs and minus our total controllable expenses gives us $210,777 left. Out of our $982,000, we have $210,777 left. Seems pretty good, right? Well, we still have to get to fixed costs. So fixed costs, we have 3 fixed costs, right? We have occupancy cost. So that's rent, property taxes, and property insurance. Those don't change from month to month. You might be able to renegotiate your lease from year to year, but your rent doesn't change from month to month. Interest. So interest in cost of borrowing money. That doesn't change if you've taken out loans or mortgages to run your business. And then depreciation. Depreciation is the last one. And a lot of people don't understand what depreciation is. So picture depreciation as a car you bought. If you spent $5,000 on a car today, in 5 years, what's that car going to be worth? Maybe $1,000? So the depreciation is the difference between those points, right? $5,000 to buy the car, it's worth $1,000 in 5 years, so it depreciated by $4,000 over those 5 years. So it cost you $4,000 to have that car. Same thing goes with equipment, right? Your equipment is going to depreciate over time, and you're going to factor that cost in so that you have the ability to replace that equipment later at a later date, right? So now we're getting into the final bottom of our income statement. So we've got our total fixed costs, and then we've got profit before taxes. So our income before taxes. What are you going to get taxed on? Not your total sales, because that's not the money you actually made. You're going to get taxed on your profit, okay? So if we look at the last section here, we've got our occupancy costs, which would have been our rent, our interest on our mortgage payments, our depreciation. So we have a total fixed cost, which are those 3 items there. They add up to $159,224. Our profit before taxes is now our income left minus our total fixed costs gives us this. That's our profit, 5.2% of our 982,000 whatever, right? Now they've calculated income tax of $12,213, another 1.2% of our total 900 and whatever $1,000 it was. So our net income, sometimes considered NOI, or net operating income, is $39,340, or 4%. Out of that almost $1 million, we took less than 40 grand to the bank. Good? Bad? Depends on the business, right? If we're doing this as monthly revenue, we're taking 40 grand to the bank every month. That's not bad, right? Okay, so just to go over, all those percentages that we calculated are just like this triangle, right? If it's occupancy cost divided by sales gives us our percentage amount, right? The caveat, and I'm going to say this again because people make this mistake, is food cost and beverage cost need to be based on their respective sales, not on total sales. Food cost needs to be calculated on food sales, and beverage cost needs to be calculated on beverage sales. Okay? All right. A couple quick examples here. So on an income statement, marketing is listed as $7,000. Our total sales are $380,000. So what percentage should be written next to marketing? Well, $7,000 out of $380,000, another zero there, is going to give us 1.8%. That's what should be on our income statement. We spent 1.8% of our total sales on marketing. Okay. Next example. So what happens if, when we're doing our budget, we need to alter that? Is that the next one? Income statement lists food sales at $114,600 and the manager wants to run a 30.4% food cost, what should food cost be written in dollars? Sorry, I was jumping ahead with the budgeting. That's the next video. So we have an income statement that lists our food sales as $114,600. Management wants to budget 30.4% food cost. How much money do we have to spend on food? So we can go back to our triangle, and we had our food sales, food cost percentage, and then this is our food dollars, right? So our food sales are $114,600 times our food cost, and we need to turn that into a percentage, 0.4, which is going to give us $34,838 to spend in order to generate $114,600 in sales, as long as we can maintain that 30.4% food cost. Okay. All right. Next video, we're going to start looking at how we analyze this compared to a budget and move on from there.